Wow, that's some serious growth there. 10x in about 10 years. Hi everyone, welcome back to my channel. Today we're taking a look at Amazon and I'm going to do a quick valuation, just a high level valuation of this by going through my 9-point checklist, and then I'll give you my opinion at the end. So look, let's just jump straight into it. Okay, now Amazon of course doesn't need much of an introduction. We all know what's going on here. Just so you do know though, they are not just in America, they're in Canada, Mexico, the UK, Japan, Germany, France, Spain, actually most of Europe now, and Australia, which is of the last couple of years they've just moved over there. They're about a $1.75 trillion market cap company. It's massive. It's not the biggest in the world. I think Apple's a bit bigger, but yeah, this is one of the biggest. The rumors are around that they're kind of cruel to their employees, their lower level employees. You hear of these stories about Amazon delivery drivers having to go to the toilet in their trucks. And look, I don't know about this stuff. I assume like all big companies have issues with low level employees. I don't know, but there's maybe there's a moral issue here for some people. Another part of their business that they have that is often completely overlooked by investors is their AWS, which is the largest cloud service provider in the world. AWS was a bit of a hidden part of their business for many years, so they could get this massive advantage over the competition like Microsoft and Alibaba, and I think they have 40% plus market share. So yeah, big part of their business, and it's very profit generating at the moment. Now, I personally have a very close association with Amazon because I ran a physical products company and sold most of my stuff on Amazon in America. So I'm very familiar with how the third-party fulfillment stuff works. And as a seller on Amazon, I'm very familiar with their backend and what they're kind of doing and kind of how they're squeezing the suppliers of their business and bringing out their own products. They definitely control the show there. So I'm pretty familiar with working with Amazon. Now, after saying that, Amazon might be a fantastic investment. I'm not really sure. So I really want to go through just some of the numbers here and we'll get a feel whether we think this is a really interesting opportunity or not. Then we can dive deeper into the company later. So the first thing I want to look for is revenue growth. Now, I'm pretty confident this is going to be growing. Amazon has definitely been getting bigger. Back in 2011, it was about $48 billion in revenue, and it's actually 10x since then to about $440 billion of revenue. Wow, that's some serious growth there. 10x in about 10 years. Whew, okay, we can definitely give them a tick there for revenue. Next thing we want to go check for are the gross margins. Now, gross margins were, well, over the sort of 5 years ago, they were sort of the low 20s, high teens kind of numbers. And more recently, they're sort of mid 20s. So in that 25, 26% range. So it has been improving, which is good. I know they've been sort of tightening the screws and putting their fees up a little bit and all these little things that they've been optimizing to improve their margins. So that's making them more profitable. But I really like margins above 40%. But the thing with Amazon is they're trying to be the lowest cost provider of online shopping essentially. So I know I want to see 40% gross margins, but Amazon's a bit of an exception here, with being just the size that they are and their gross margins have been growing. I'm actually pretty happy with that. And Nick Sleep will tell you this is like one of those scaled economy shares kind of businesses where the savings made by Amazon get passed on to the customer. And look, I'm happy to give this a tick actually for gross margins. Next up is return on invested capital. So it wasn't great 5 or 6 years ago, but it has really turned into sort of good, strong double digits since then. For the last 3 or 4 years, it's been between 10 and 16%. Happy with that. Yeah, we can give that a tick. And now let's go have a look at the debt situation. Now, we don't want debt to be too big because the repayments will be a bit of a burden. Now, if I look at the short-term debt, well, we've got more current assets than current liabilities, so that's fine. But we have significant more long-term assets than long-term liabilities. So overall, they have significantly more assets than they do liabilities. I'm probably okay with that. The debt situation seems to be, the debt to equity ratio is only at 45%. Yeah, I'm pretty happy with that. We can give that a tick as well. Next up is free cash flow. Free cash flow is very important. That's really what we're going to get as shareholders. Now, about 10 years ago. We want to see this sort of growing with the revenue if we can. So it was about $2 billion, hovering around that mark there about 10 years ago. And then it's really jumped up to now, well, 2020, the year finished at nearly 26 billion. The trailing 12 months looks like it's going to be a lot lower. Maybe it looks like the cap spending number is really high here. So they've obviously been investing in something. I don't know what it is exactly. But generally speaking, free cash flow has been growing, as we can see over the decade. And yeah, with the amount of revenue that's growing, that will translate into free cash flow into the future, as long as that cap spending number doesn't get out of control. But it all looks pretty good here. That's definitely been growing. Now, if you're wondering what brokerage accounts that I use personally, well, I use Interactive Brokers and Saxo Bank. Interactive Brokers is my preferred brokerage account. There's actually a link in the description, and you can go have a look at it, like even a demo account, to see whether you like the look of it, if it makes sense to you. The reason I like these two accounts is because they've got long histories, they've been stable, they give me access to international markets, which for me is very important. And the fees are really low. Well, especially for Interactive Brokers, their fees are fantastic. So it's not zero free trading like Robinhood and things like that, but they don't have any hidden costs like Robinhood either. So Interactive Brokers, I think, is the best of the best. Next up is shares outstanding. We want to see this number stable, if not declining. If it's growing, well, it means our investment in the company is actually getting diluted. So it actually has been from about 460 million 5-10 years ago to now 500 and a little over 500. So it has been slightly increasing. It's not dramatic. It's been probably only going up maybe 1 or 2% per year, but it has been growing. So we're going to have to give that across. Next up is insider ownership, and we just want the management team aligned with us as shareholders. We want us to be on the same page here. So, well, Jeff Bezos is obviously the richest man, and I think he's the richest man in the world anyway. He's not the CEO currently. He stepped down from that role, but I still think he holds 10% of the company or something like that. Andrew Jassy is now the CEO, and he has, looks like $310 million worth of ownership in the company. His compensation is about 35 million. So it's about 1/10 of his ownership in the company. Therefore, his net worth, it is more important for the share price to appreciate than him to just keep getting his salary. So that's all I need to see, and I'm happy to give that a tick. Next up on my checklist is to take a look at what super investors are also invested in Amazon. Now, look, I'm not that smart, and I think that some people who have decades of experience and manage huge amounts of money, they're smarter than me, a lot of these guys, and I would build up more conviction in the idea if they've been investing in the company. So people like, we've got David Tepper, he has, well, 9% of his portfolio is in Amazon. That's some pretty big conviction. Even though he's reduced it a little bit of late, it's still a very big part of his portfolio. We've got Stephen Mandel, we've got Thomas Gaynor, we've got Bill Miller, Daniel Loeb, even Warren Buffett at Berkshire Hathaway has invested a couple of quarters ago now. They have a small stake in Amazon as well. So look, this is a bit of a who's who of the value investing community, and I'm very happy to see that. So last up is the most important thing, which is the price. See, nearly anything can be a good or a bad investment, depending on the price we're going to pay. Look, a great company that's super overvalued is going to be a bad investment. It's going to give us bad return on our money. So we need to pay the right price, no matter how good the company is. Now, to check that, I use my intrinsic value calculator, and there's a link in the description for that. It's free if you want a copy of it. Now, I've already gone ahead and put in some of the numbers here for Amazon. Look, I know people are going to think this is insane, but I think I would want to be looking at buying this at around about $600. Now, before you get all crazy about that, the reason is because I want a discount rate of around 30%. You might be thinking that's crazy. Well, it is, but I want to get somewhere in the 20% range as my return on my investment. And if I aim for 30, well, hopefully, there's probably some things that are going to go wrong, and just to build in a margin of safety, I go for 30, hoping to get somewhere around the 20% range. Now, look, Amazon is a massive company. I've got it growing at 25% per annum for the next 5 years. I actually think that's pretty aggressive, and I can't imagine a $1.75 trillion company growing at 25% per annum. So I actually think I could drop that down to 20%. And now we're talking like $500. Now, if I go have a look at the actual share price at the moment, I think it is in the 3,000s, 3,400 at the moment. So obviously I'm not even in the ballpark here. So I'm going to tinker around here with these numbers. So, okay, I still think 20% is probably on the fair side of its growth for the next 5 years. Remember how big the company is. I think my return on investment goal, instead of making it 30%, maybe I'd be okay with such an amazing company trying to aim for 20%, thinking that my margin of safety get me hopefully 15%. And we're still only looking at like $1,000. So I can't get around Amazon. Like, I guess the multiple, like I know the PE ratio for Amazon has always been really high, like 60 to 100, but that's not, I don't think that's right considering the PE multiple, or this is a price to free cash flow multiple, should be related to the growth rates. And if I'm only going to get 15 to 20% per annum, it really only deserves about a 20, maybe a 25. Let's give it 25. I'm still only $1,200 anyway. So look, that's just my opinion. I know a lot of people are going to disagree with that, but that's okay. So here's my overall opinion on Amazon. Look, the financials are really great. It's one of the greatest companies of the past 20 years. There's so many super investors involved. Look, just the market cap being so big, I think that 25% growth rate is going to be hard. That's what they've been doing for the last few years. That's why I put 25% in. But look, I guess it's still possible for a while, but I just don't see this being a 5, 10x return at these prices. I just don't expect this to make us rich. And I think it's going to be a bigger company in the future. There's a lot of the world to still to expand into. There's probably a lot of projects that they're working on, a lot of moonshots that could go really well. I just think that we're only going to get market average returns with Amazon, and it's a great company, but it's just not a good price. And that's it. I hope you enjoyed the video. Leave a like if you get something out of it. Leave a dislike if you super disagree, but that's fine. And I will see you in the next video.